Yes, sir. Question. You're not. Nope, that's not what I mentioned in the beginning. The question was, your buy, if you're trading on a daily chart, isn't your buy the next day? No, your buy is when? 15 minutes, within 15 minutes before the close of that day. Buy into the close. Don't cut it so close that your order doesn't get there. Buy 5, 10, 15 minutes before the close. And the selling part is an art as well, because look at this sell bar. Well, look at this one. So let's say this was, you accumulated. You bought this tail bar below the 20. You add it here. You add it there. You even add it on the bottoming tail bar. And one more for good measure here. Boom. And here's your reward. And maybe even this little, you can't see it, it's a little red. This RBI, one last buy. And then this thing takes off here. All right, now remember, you got purchases here, you got a purchase here, you got a couple purchases here. There's an average cost here. So now you're here, you take some off the table, all right? Maybe you cut the trade in half, and then this bar opens. Now when that bar opens, that's not a big green bar, it's a dot at the open. The first trade's a dot. Then it grows to be a little green bar. Then it grows to be a medium-sized green bar. Then it grows to be a big green bar. Now, the question is, at what point do you sell? At what point of bigness? Because it could get bigger. And so as long as the green is remaining, you can hold on. And as the green is growing, you can hold on. But if the green starts to erode, what will it start to leave behind on top of it? A tail. If your tail starts to grow on your green, get out. Make sense? Listen, this is simple. It's just not easy. All right? It's simple. You know the story. It's just not easy. It's not easy because look at this bar right now. Let's stare at it. It's not moving. When it's moving, it's a different ball game. You know? I've watched some of my traders trade. Some of them are so nervous they're like this. They're watching the screen and they're like their hands are reaching for the keyboard and then they don't, you know, that's a trader. The market's playing that trader. That trader's not playing the market. The market's playing that trader. Do I get out? Do I get out? All right. Yes, sir. This bar? Oh, yes. Yes. So remember, you sold part of your position here. Now, this bar opens, drops a little. Now it's a little tiny red. Then it gives up all the red and then starts to be a little bit of green and starts to grow. Fine, of course, you're going to give every bar some room. But remember, you already took profits here. So I believe in the incremental sell. And if you sold half here, you're going to sell half of the half. You don't kick yourself because you sold earlier. As long as you have some left, that's a good thing. And if the very next bar tells you it's a sell bar, you sell it again. You sell the half of the half if you want to hold on to some. And then if another one happens, you sell the half of the half of the half or sell it all. All right? And I guarantee you, you will get a piece of your merchandise off at the top. You'll get some off early, but you'll get something off near that top with an incremental sell approach. Yes, sir. Yes, there are ways we do that, all right? It's beyond the scope of today's talk, but yes. Now remember, you can treat every trade like an individual trade with its own stop. So this one stop is under this low, this bar stop is under that bar's low, this individual trade stop is under that bar low, so if this one gets stopped out, you still have these two. There are multiple ways to skin this cat. Or you can have one global stop based on the average cost of all of your trades. Does this make sense as well? So all of these things we teach our traders. There's trade management. Once you have a strategy, that's not the management part of it. You need trade management. You need to know how much do I buy on this bar versus that bar? All of these things are taught to our traders and drilled into them every single day of their lives. Bull elephant bar, below the 20-period moving average. Nice, nice, nice. But there was, all right? Exhaustion bar, way above the 20. Way above the 20-period moving average. So you're selling into this bar. You're buying into these bars. Yes, sir. This one? No. No. Topping tails are to be sold where? Way above the 20-period moving average. That's when they're significant. Topping tail below the 20 is insignificant. In fact, it's bullish. Because where was it? It just gave up the ghost a little bit, but it's showing you the first signs of elephants coming in a little bit. All right? Elephants starting to come in. Look at these tails. You can't have tails unless there's institutional accumulation. All right? Tail. Nice spike, and then they quiet it down. Spiked up again. Here's the sign of all of this accumulation. Tails, tails, elephants. All right? And they all happen like that. They quietly start happening. You start to see a cluster of tails. Oh, here's a tail. Here's another tail. Here's an elephant. Here's a sizable green bar. That's them accumulating. Eventually, there's going to be no more stock available in this $5.50 area. And the only way to get more stock is they're going to have to reach higher. That's what causes stocks to rise. When institutions start reaching higher, well, you don't have any for me at $5.50, give me some at $5.75. In fact, I'll take everything you have up to $6. Just give me all of it. And that's when you see things, and that's how they play. Now, these players wish that they can step in and make no bar. But they can't. You see, institutional heads of hedge funds and stuff like that, when do you see them on CNBC getting interviewed? Before they're accumulating? They're really absent when they're accumulating. But they want to be on the show. Our top 5 holdings. That's here. All right? They're on the show this day. Right? Not this day. Absolutely. This one?
Your 13 bars at red top, that would typically be your second most bearish candle in the chart versus but it's not.
That would be the...
That's only relevant to
Perfect. I couldn't have said it better. Its bearishness is relative to where it occurs based on the 20-period moving average. If this bar were up here, it would be the kiss of death. It's under the 20, so it loses its bearishness. But all of these are nuances that, obviously, we cover in our full program. Guys, bottoming tail bars, guys, this is a part of the presentation I gave yesterday. There are regular ones and kamikaze tail bars. The kamikazes happen way below the 20. The regular ones happen at the 20. Now remember, whether it's an elephant bar or a tail bar, you want them under or at. You don't want them way above. You can have them a little bit above, so it's at or near or under. It's under or at or near. If it's at or near, it's a regular one. Please buy them. Do not skip a regular bottoming tail. But oh my goodness, if you get a bottoming tail way below the 20, with a lot of space between the high of the tail and the 20-period moving average, I want you to bet everything you have on that bar. There are intelligent moments to risk everything. You will never be a big trader if you play every trade the same. The astute traders know this is one of those opportunities you put all the chips on the line. And this is an opportunity you put maybe a quarter of the chips on the line. You've got to know the difference. And in fact, it stops being intelligent if you don't take advantage of those moments, because it's those moments that throw a trader so deep into profitable territory they can't be a loser in the long run. Now, regular or kamikaze? Regular. Yes, it got way below the 20, but what's missing is that there's no space between the top of the topping tail's head and the 20-period moving average. There's zero space. Buy it, yes. What are you doing on this bar? Taking profits, absolutely. Can I give you some money? Can you do this? Will you be able to spot, if I gave you a chart, will you be able to spot a fat green bar, bull elephant bar if it forms? Now, would you? For real? I'm going to test this out. We'll see. Watch. I'm going to see. I'm going to really see if you can spot opportunity. Bottoming tail bar below the 20. Space between the head of the tail bar and the 20. Not a lot. It's not quite a kamikaze because I like that space to be really fat, but it's getting closer. I'm going to buy that bottoming tail bar heavier than I will a regular one. You've got to know when to step on the pedal a little bit heavier and when to step on it more lightly. And here's your reward. But guys, listen, here's a kamikaze. Now look at this bottoming tail bar. It's deep below the 20. There's a ton of space between the high of the tail bar and the 20-period moving average, a lot of void. Now think of this in a rubber band theory. Rubber band. So here's your rubber band. You pull the rubber band deep enough, it's violently going to snap back up. You pull it deep, high enough this way, it'll snap back down. So trading successfully is really based on trading a certain standard deviation away from your 20-period moving average or at your 20-period moving average. The rubber band theory. The odds of this staying way below the 20 are low. Stocks can get way away from the 20. They can't stay way away from the 20. They can get there, they can't stay. They can get there, they can't stay. So we act on the outsides heavily. Does this make sense? Kamikaze is a heavily traded kamikaze bottoming tail bar. I'm going to dump everything I possibly can into this bar. Now, let me tell you something. There are times when I'm going to put my stop under that bar, but you can potentially get nicked out of it. So when you get stopped out, if the play comes right back after stopping you out, what do you think I want you to do? Put it all back in again. I want you to get back on that horse like nobody saw me fall, right? Okay, just good. All right? Pretend like you didn't even get off. Just get right back on. I found that we've done studies on this. 78% of your losing trades turn to winners with a re-entry on the same stopped out stock if it comes back relatively quickly. You'll turn 78% of your stop outs into winning plays. Imagine eliminating 78% of your losing trades. Powerful, powerful. Kamikaze, entry, stop. All right? Now, let's say you consider this the kamikaze with a stop under the low. This bar stops you out, but the same bar comes all the way back. Get right back in on that bar. And if you have money left, please buy that bar. And if you don't have money left, visit your neighbor and borrow some, or your relatives or whatever. Leverage up, baby. Leverage up, please. All right, now.